All right. Hey, friends. How are you today? Hope you're feeling great. I'm feeling great. I also hope you can hear me. Hey, would you mind hitting that questions box for me and letting me know if you can hear me or not? I would really appreciate it. Just give me yippers if you can hear me. All right. Thank you, Mike and Stephen and Gabriel and David and Yeesher and Justin and Brett and Tomas is here. Oh my gosh. Thank you all for showing up. I am very, very happy to see you. Larry, oh my gosh, why did I even start without knowing that Larry's here? What's up, Larry? How are you, my friend? All right. Today we're going to talk about something that matters a whole darn bunch. How to use delta to maximize leverage. Now, before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. Everything we're doing here today is providing generalized information, not specific to your situation. And for those of you who don't know me, which I don't, that's not a lot of you, which is nice. We have our, weekly family reunion over here. But I did see some new faces here. Well, not literally, but I saw some new names here. And welcome. I'm so glad that you're here. If you're not familiar with me, my name is Dan Passarelli, and I am an author of two of the most popular option trading books. Trading Option Greeks is the one that I am most known for, and The Market Taker's Edge is the other one. And I'm working on another one, but it's taken a long, long time here, friends. So let's see here. Aside from that, I am also a trader. I've traded for years on the floor of the Chicago Board Options Exchange, as well as traded off the floor professionally. I also have traded for years now, a couple decades now, in what we call a retail trading account, which is the same kind of account that you are in with Firstrade. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. Founded that 17 years ago. Oh my gosh, do you believe I've been doing that for this long? Wow. And I also, besides my work with Market Taker Mentoring, I collaborate with all the good actors in the options trading space, leading brokerage firms like Firstrade, for example, as well as many of the exchanges globally. And I'm a family man, married to my wife, Kathleen, who many of you know. She runs operations here at Market Taker, um, takes care of our customers, our traders, and our one-on-one coaching students, of course. And I have my two adult children and my two little runt dogs. I do other things for fun besides family and trading. I'm a runner, a foodie, traveler, and a music person. Now, enough about me. Let's talk about the important person here. Let's talk about you. What we're doing today here is getting you boned up on using delta to maximize your leverage. But as they say, the more you learn, the more you earn. The more things that we can give to you, the better. And so when you're done here today, you should go to our website, markettaker.com. It's market as in stock market, taker as in take what is rightful yours, two T's in a row. Markettaker.com, and just simply click on the button up there in the top right hand corner that says join free. And we've got lots of free classes and free stuff for you that is designed to make you a better trader. Now, how to use Delta to potentially maximize leverage. So we're going to be talking largely today about directional trading. And hey, let's face it, directional trading is a big part of what we do when it comes to trading, right? Well, I know a lot of us use spreads like credit spreads and time spreads and iron condors, and those are very, very useful strategies. But so is directional trading, especially when markets are shooting straight up like they have been for a while, or pulling sharply back like many people believe can and is likely to happen soon. And so we've got to know how to use options to trade directionally, to hedge directional positions. I mean, this is important stuff here. So we're going to do a quick review of options. We're going to talk about delta, and then we're going to talk about delta and leverage with buying calls and buying puts. And if there's time, we're going to answer some questions. So there's a couple motivations for direction. I mean, there's two motivations for directional trades: momentum and value. So momentum, we're mainly using technical analysis. We're looking for trending stocks. Now, because these are options, these could be stocks that are trending higher, and these could be stocks that are trending lower. We're looking for sometimes moving average crossovers where the shorter term moving average crosses above or below a longer term moving average. Directional indicators like ADX, RSI, MACD, slow stochastics, and those kind of things. And, you know, we could be looking for reversals in momentum as well, looking for bounces off support, bounces off resistance, where it could indicate a new momentum direction. And we could be talking about value, where we're buying dips or selling peaks within that momentum move, overbought, oversold, which again is using support or resistance bounces, and maybe even using fundamental data. Now, when it comes to directional trading, there are several different vehicles we could use: stocks, futures, options. And when it comes to stocks, well, you know, we could look at ETFs like, you know, SPY and QQQs and diamonds. When it comes to futures, where we could be talking about S&P 500 futures, E-minis, or, you know, gold and silver for that matter, oil. We could even be talking about that. But when it comes to stocks and futures, they're not really binary outcomes where it's you make this or you make that, but they're binary outcomes from the perspective of they either go up or down, right? There's nothing else. They go up or they go down. That's it. But when it comes to options, it's a little bit different. There's more to them. Even if you want to trade directionally, you still have to worry about time decay. You still have to worry about implied volatility. And when I say worry about it, I'm not saying, I guess I don't mean worry about it. I mean, think about. So why options? Well, as far as for directional plays, why options? There's one big major reason. Calls are cheaper than buying the stock, like a ton cheaper. Now they have a little less directional exposure, but they're massively cheaper. So we have either way less capital at risk for maybe a similar financial outcome, or the same capital at risk, but we can just make or lose a ton more. So what this means is leverage in either case. So a common strategy used to exploit leverage characteristics of options is to use them to trade directionally, focusing on their delta. The results can be unexpected if you're not educated on this. The results should not be unexpected, and they don't have to be unexpected. And for those of you who stick around to the end of our workshop today, they will not be unexpected. All right. Is anybody new to options here? Yes, hit me a yes if you're new to options. I know Baron's not, and David's not, and who else here? Justin, of course, is not. Larry's not. Nobody's new to options. Mike's not, right? Tomas is not. Nobody's new to options? Okay, good. Then we're just going to do this. Oh, Gabriel? Okay, good. Good, because I have the slide here. I was planning on going over it. So a quick tutorial. A call option is the right to buy the underlying asset at a specific strike price on or before the expiration date. Puts the right to sell the underlying asset at a specific price, the strike price, on or before the expiration date. So if you think about it, if I have a guarantee that I can buy the stock at this price, X, the higher the stock goes, the more valuable X becomes. So we end up with this direct relationship where when the stock goes up, calls go up. When the stock goes down, calls go down. And vice versa with puts. When the stocks go down, puts go up, right? Because we have the right to sell it here at X. And as the stocks go down, that makes this right to sell it here much more valuable. Again, direct relationship. Stocks go down, puts go up, stocks go up, puts go down. Indirect relationship, sorry. Okay, so we have these directional influences that we just talked about. So when it comes to using options, we can get super fancy and use spreads and multi-leg spreads and all these other things, but we don't have to. I know some of the pretty experienced people here, you probably use spreads, and more often than not, I guess I do too when I'm actively trading. But one thing that I do know from talking with people in the industry who like maybe, you know, are higher ups at brokerage firms and who know these answers, or higher ups in exchanges and know these answers, the most commonly traded option strategies that there are buying calls. Well, that one's the most popular, and the second is buying puts. And then we get into spreads. So this is what people do. And when you just go out and buy a call or just go out and buy a put, that's called outright. Outright just means not part of a spread. And it also sort of, like the nomenclature evolved into meaning long options. If we're just selling a call, not part of a spread, that we would call that a naked call instead of outright. I mean, it doesn't really matter what you call it, but that's what is conventional in our industry. So if we buy a call outright, we select the expiration date, how long we want that right to exist, what strike price, what price we want to have the right to buy the stock, and that's going to affect our leverage because it affects our what? Delta, right? And we also have to forecast how much we expect the stock to rise because that's going to drive our expiration and our strike price, our expectations, how we manage the trade. And all that's the same for the put if we're talking about a downward move. So let's talk about the long call here. If the stock rises, I may potentially make money. Now, hold on a second. Passarelli, didn't you just get done telling me that when stocks go up, calls go up? Now you're saying potentially I make money if the stock rises? What gives? There's a lot of things at play, and you better know them. So if the stock rises, I may potentially make money, but how much? I need to have this expectation. I mean, if I took my life savings and I wanted to save for retirement and I put it into some investment that is magically guaranteed to make money, because nothing's really guaranteed to make money. But if I put my life savings into something that's guaranteed to make money, put it all in there, wouldn't that be great? Not necessarily. Not if the guarantee is I'm going to make 1% in the next 30 years. Given inflation, I would be losing real value. That would destroy my life and ruin my retirement. I need to have some idea how much I'm going to make on any investment. What if the stock falls? I'd probably lose, right? Yeah, I mean, I would. So how much would I lose? Well, the first thing we have to talk about is delta. If the stock goes up, the call will go. If the stock goes up today, the call will go up today, probably, except for a couple of circumstances. But it'll go up by less than the stock goes up. That's because of the delta. Delta estimates how much an option's price may change relative to a change in the stock price. And it's a percent. If the stock goes up $1 and the delta is 37, the call will go up by 37% of $1, which is 37 cents. If the stock goes up $2.34 and the delta is 54, how much does it go up? Well, I just say, what did I say? $2.37 the stock goes up times 54 delta. I'd make $1.28. Just do a little bit of arithmetic. Delta is effectively a measure of the leverage of an option, if you think about it. That's by definition what that means. And it's stated as a percent. Now, as far as percents go, there are some rules of thumb. Now, this is important stuff. If you don't really know too much about delta, this is a really good thing to know. We all know what in the money, at the money, and out the money is. For a call, if the strike is below where the stock is trading, that means if I exercise it, I could buy it below where the stock is trading. So it's in the money. It has what is called intrinsic real value. And it probably has time value also. But if an option is out of the money, that means the stock is, here at X, but the call strike price is above X. I have the right to buy it above where the stock is, which means I would not exercise it. There's no intrinsic value. There's only time value. So those are in the money and at the money definitions. At the money, I bet you can guess what that is. Strike price and the stock price is about the same. So the definition of delta that I just gave you is it's how much the option moves relative to the stock price. But another way to think about that, which is actually, if you think about it, it's kind of the exact same thing, but just saying it differently. It's the likelihood of an option expiring in the money. Ooh, is that really the same thing? Well, it's kind of the same thing if you think about it. This is what I would call the trader's definition, and that's not on the screen anywhere. It's not on a slide, so write this down. Delta is an estimate of an option's likelihood of expiring in the money. Delta is the estimate of the likelihood of an option expiring in the money. Somebody just raised their hand. I saw that. Well, you're probably raising your hand to say, Dan, that's not mathematically correct. Are you smoking something funny this morning? No, I am not. But you're onto something. It is not actually mathematically correct. But it is indeed a loose rule of thumb that every option trader I have ever known in my entire life uses and knows about. So you can think about it loosely, just know that it's not an exact relationship, okay? So if an option, and we'll just use this in terms of calls here. If a call is in the money, right? Like I have the right to buy it below where the stock is trading. I've got a head start of it being in the money at expiration. More than a 50-50 chance, obviously, right? If the stock is right at the strike price, I've got about a 50-50 chance. Could be up a penny, could be down a penny, 50-50 shot. But if it's already in the money, it's more than a 50-50 shot. It's got a head start. If the option is out of the money, well, it's got sort of a negative head start. The stock's got to go up. It's instead of down, it's got to go up in order for that option to be in the money. So it has a less than 50-50 chance of being in the money at expiration. The more in the money, the better the chance. Like if I had $100 stock and a 10 strike call, I mean, it's extremely likely that call is going to be in the money at expiration. It's going to have a delta of close to 100 because it's got a close to 100% chance of being in the money. If I've got $100 stock and I'm looking at the 300 strike calls, well, that's got about a 0% chance of being in the money at expiration. I mean, maybe if there's 2 years until expiration, maybe it's closer to not 0. But I mean, if there's like a week till expiration and I'm 200% out of the money, there's about a 0% chance of being in the money. I mean, it's never exactly 0, but about 0. So the delta would consequently be about 0. Everybody get this? This is easy, right? Okay, so now let's talk about leverage. We're going to start with the long call. Let's say that I'm studying a stock. Doesn't matter what stock it is. But I'm bullish on this puppy. Maybe that's because of a moving average crossover. Maybe that's because of some fundamental analysis we did. Could be because of anything. But hopefully it's because of something smart, not just like, seems like this stock might go up. Yeah, like we don't want to do that. So we did our research and consequently we have a bullish forecast. One way I can play this is I could buy a call. But how many calls would I buy? Well, geez, there's a lot to unpack there, right? That's very situational. One thing I need to know for sure is if I buy one calls, how many shares am I controlling? Well, in theory, I'm controlling 100 shares because if I exercise that one call, I get 100 shares. So in theory, I am controlling 100 shares. But what did the wise sage Yogi Berra say about theory? In theory, practice and theory are the same, but in practice, they're not. So what if I actually want the exposure of 100 shares? Well, that's kind of different. How many calls would I be able to or need to buy? Well, there's two considerations there. Capital outlay and delta. So let's say I've got a $50 stock. The delta of shares of stock is 100%, 1.00. Why? Well, that's because of still kind of another definition that is basically a restatement of those other two, ties into them. Delta is how much the option acts like the stock. If the stock goes up by $1, how much does the stock go up by? All right, goes up by $1, right? Because it acts 100% like itself. It moves 100% like itself because it is itself. But calls are different. If I'm looking at the money call, 50 strike call, stock's at 50, the stock goes up by $1, how much do I make? Well, I make 50 cents, right? But how much do I pay for the stock? $50 a share, 100 shares, it's 5,000 bucks. The call is $4 a share, so that's $400. So, okay, what if I bought two of these calls? Well, if I buy two calls, $4 a share times 2 is $8 a share, so it's 800 bucks. And the delta is 50. It's 50, it moves 50% of the underlying. So 2 times 50 is 100. So, if I buy two $50 calls, it's going to move 100% like the underlying. Holy cow. Okay. Well, now I'm actually kind of onto something here, right? So I can look at this as sort of a choice here, right? I could buy 100 shares of a $50 stock and pay $5,000. And if the stock goes up by $1, I make 100 bucks. If the stock goes down by $1, I lose 100 bucks. Or I could buy two 50 strike calls, in which case, in this example, I would pay $800, which is a lot less. I mean, how much less is that? 800 divided by 5,000. I'm investing just 16% of the money. But if the stock rises by $1, I make about 100 bucks. If the stock falls by $1, I lose about 100 bucks. So I'm getting 16 to 100 leverage, or 16 to 1 leverage, I guess is how you would think about that, right? Wow. I'm controlling 16 times more directional sensitivity, or I'm putting up, 16% of the money to control the same directional sensitivity. Again, you think about it either way. Because if the stock goes up by $1, I make about $100. What does that mean, about $100? What is Passarelli talking about now? Is he trying to trick me again? Who can tell me? Why do I say if the stock goes up by $1, I make about $100 on these two 50 strike calls? Let's see who's smart here. You never know. I've been known to give away prizes. Delta changes is one of the answers. Very good. Very good. Barron's talking about delta too. Also, right? Right. Oh, there you go, Justin. There's an answer I'm looking for. A restatement of your first answer. Gamma. Now, wait a minute. We didn't talk about gamma yet. What does gamma mean? Well, if the stock is at 50 and the call is at 50, that's at the money, and it's got about a 50 delta. It's technically a little bit more, but just think about it as 50 delta. But if the call is at 50 and the stock goes up to 51, oh, now the call's in the money. The delta has to be bigger. That's called gamma. As the moneyness, how in or out of the money an option is, as the moneyness of the call changes, the delta changes. The call deltas are going to get bigger as the stock goes up, and they're going to get smaller as the stock goes down because the calls are getting more out of the money when the stock goes down. So what that means is when the stock goes up, I make money at an increasing rate. I'm going to make a little bit more than $100 based on delta. If the stock falls, I'm going to lose a little bit less than $1 because it gets more out of the money. Now, Justin, that is just one answer. Who else is smart here? Justin's, he's like Johnny on the spot over here. He's just like boom, boom, boom. He's got all the answers. He's putting you guys to shame. Come on. Who is going to give me an answer here besides Justin? I mean, Justin, you can go ahead and answer. Just keep shutting these guys out, man. Put them to shame. But what is another reason why I make only about $100? I'll give you a hint. Ah, there we go. Thank you, Justin. Jeez, Justin's just shutting you guys out, man. Theta and the other Greeks. I didn't say over what period of time. What if the stock rises $1 over the next week? Well, that option's going to lose value because of time passing, which is measured by the Greek theta. Now, I know we didn't put that in the presentation just yet, but I'm throwing it in there now. And Justin points out the other Greeks, namely, I mean, you know, there's a couple more Greeks we didn't talk about, but namely Vega, implied volatility changing, which could theoretically go either way. Typically, for a typical stock, when the stock goes up, implied volatility goes down. And when the stock goes down, implied volatility goes up. But that's not an always true rule, but for most stocks, that's usually true. Okay, so this is a picture of leverage. This is what these words say and these numbers say. It means leverage. I only have to invest 16% of the money and I get all the profits. And in some ways, it's arguably better because I make more if it goes up and lose less if it goes down. In some ways, it's arguably worse because as time passes, I lose via theta. So let's talk about this leverage. And for those of you who like to have formulas in front of you, well, you're in luck because here's a formula. The delta times the option quantity equals about, that's what those two little wavy lines means is about equal to. Sometimes people just use a tilde. That's kind of the non-math nerd way to write it, I guess, but I'm not really a math nerd. I wish I was. I used to be, but you get old, you start getting rusty on some of these math concepts. Delta times option quantity equals about the equivalence of the shares of stock that you're long. What am I talking about? Well, if I buy 425 Delta calls, that's like being long 100 shares. Why? Well, 4 times 25 is 100 is how you look at that. Well, actually, to keep with the chronology of the formula, delta first, right? 25 times 4 contracts equals the exposure of long 100 shares. Exposure of long 100 shares? What does that mean? Well, it's like being long 100 shares. It's about equivalent to being long 100 shares. Because if the stock goes up a buck, I make about a buck. If the stock goes down a buck, I lose about a buck. So that's a way to think about options. It's the equivalence, the exposure equivalence of how many shares you would own. If I own 125 Delta call, it's like I own 25 shares. Or at least that's how much I'll make or lose if the stock goes up or down. So if I buy 4 of them, it's basically like I own 100 shares as far as my directional exposure goes. If I buy 330 Delta calls, that's like being long 300 shares. No, wait. If I buy 10 30 Delta calls, that's like being long 300 shares. If I buy 540 Delta calls, that's like being long 200 shares, etc., etc., etc. And for those of you who trade spreads, it's the same idea. We just net out the deltas. I'm long this call with a 50 delta, short this call with a 30 delta. I'm long net 20 deltas. I've got 10 spreads. It's like I'm long 200 shares. If you know that, that's going to take you far. Now, leverage is great when it works in your direction. Leverage is terrible when it goes the wrong way. It's what they call a double-edged sword. Isn't that a weird analogy, double-edged sword? Why do they say that? Like, it doesn't make sense. I don't know. It doesn't make sense in my mind. Double-edged sword. I mean, there should be a better analogy. I mean, I'm sure there is a better analogy. I just can't think of one. Leverage is a double-edged sword, though. It cuts both ways. You just turn the knife over. It doesn't have a double edge and cut the other way. But if the stock goes your way, great. You make leverage profits. If it goes against you, darn it, I'm losing leverage profits. And that's part of the call is not a perfect substitute for the stock. And that first one is part of the reason. But the changing deltas is another part of the reason. Gamma. Gamma benefits you when you are long options. But the other influences matter too. Time passing, that is always a drag on long options. Volatility can help or hurt. If we have time, I'll share a kind of interesting way to look at that. Okay, so let's talk about the long put. Now, you might look at this and say, yeah, this is the same thing, Dan. I get it. And it kind of is, but there's a key difference. So we kind of need to go over this as well. Let's say we're bearish because we did our forecast. We're not just guessing. We've got some tangible reason to put on the trade. And we're thinking about buying a put. Okay. Well, how much puts How many puts should I buy? Well, if I exercise one put, it gets me short 100 shares. But what if I want the exposure of 100 shares? How many puts should I get? This is where it's a little bit different here. We have to go capital outlay versus margin and delta. So same idea. If I I could short this $50 stock, and it's with 100 delta because, you know, it's short 100 delta though. Or I could buy the 50 strike puts, which cost me, I guess, in this example, $3. What if I bought 2 of those puts? Okay. Well, 2 times 3 is 6, so $600 because it's times 100 shares. And if it's got a 50 delta, 2 times 50 is 100 deltas. Okay, so here's what we got. We got something that looks just like what we were talking about, with a very important difference. How much do I pay to sell short 100 shares of a $50 stock? How much do I pay to sell short 100 shares of a $50 stock? Phew. That's a tricky question right there, isn't it? Because really, I don't pay anything. In fact, I get money put into my account. I get $5,000 put into my account. By who? Well, by the person I sold the stock to. How does shorting stock work? Well, I borrow 100 shares from somebody, a different customer at my brokerage firm at Firstrade. I borrow it and I sell it to somebody else for $50 a share times 100 shares. It's $5,000. I get $5,000 put into my account. So from a pure cash standpoint, I don't pay anything to short the stock, but I do have costs involved. First of all, I'll have to post some margin because I could lose. What if I'm just completely reckless? What if I had $0 in my account and I shorted 100,000 of these shares? Hey, if it goes down, great, I made some money. If it goes up, I lost money that I didn't have. Who's on the hook? Well, Firstrade's on the hook, and they don't want to be on the hook. They've got to be a sound financial institution because they have customers to protect. So they can't let you take them down. So they're going to make sure that you post margin to cover losses. And they're probably going to charge you a fee, interest, they probably call it, to short the shares of the stock. So you do have costs. It's a lot trickier. There's not a direct relate. I mean, if I buy 100 shares of $50 stock, boom, I paid $5,000. That's it. If I short 100 shares of $50 stock, how do I really figure out the leverage? Because if I buy 2 puts, I'm paying $600. Easy peasy. But how do I compare that to shorting the stock? I don't know. I mean, it's hard. I mean, probably the best way to do it is to take a look at how much margin you have to put up and divide 600 by the amount of margin. That's not going to be 16% or whatever. It's going to be less because you're not going to post $5,000 of margin probably. You're going to post something less. So like shorting stock is already kind of a leverage position, but buying puts is likely to be a much more leveraged position. Still making or losing the same amount. And so we have the exact same formula here. If I buy 4 25 delta puts, that's like having the exposure of being short 100 shares. Buy 10 30 delta puts, that's like having the exposure of 300 short shares. Buy 540 delta puts. That's like the exposure of being short 200 shares. And it's the same double-edged sword, cuts both ways, whatever you want to say. If the stock goes down, fantastic. I'm making great leverage profits. Stock goes up, yo, rot-row, as Scooby-Doo would say. So the put is also not a perfect substitute for the stock, for being short the stock, because it's just a really fundamentally different thing because of margin and, shorting costs, interest or whatever. And deltas change, time and volatility matter. Now, there was one thing that I wanted to save some time for to share with you that's not in the presentation. Do you want some bonus material? Give me a yes if you want a little bonus in this workshop here today. Give me a yes. Or, if you don't, if that's good enough, you just say no or, no. Oh, Tomas does. Justin does. Biren does. All right. Well, you guys, Mike does. David does. He's got exclamation points. He really does. Other David does. He sure does. Larry does. Of course, Larry does, he says. Joe does. Kalen does. These are some of my favorite people in the Firstrade webinars here today. Janos does. All right. Well, by overwhelming response, I'm going to give you some bonus stuff here. Now, let's go back to this. So, yeah, we understand delta. We understand how gamma changes delta. We understand theta. And I said, well, vega is going to matter too. And on a typical stock, this typically happens, but it doesn't always happen. Well, that is the most accurate answer I can give you. And I like to be accurate because I want you to be smarter. And me just giving you something that's usually true and telling you that it's true doesn't make you smarter. It makes you smarter when it works out that way, but it costs you money if it doesn't. I like my content to make you smarter so you can make more money, not lose money. So, what happens when implied volatility changes? So, when I say a typical stock, I'm talking about probably 80% of the stocks out there. When the market, when that stock price goes up, people are happy because net people are long the stock. Every share that exists, somebody owns it. Even if somebody shorted it, they sold it to somebody who now owns it. And they borrowed it from somebody who owns it. So the net doesn't change. Still, somebody owns those shares. So people are happy when the stocks go up. In fact, they probably sell some covered calls and generate some extra capital. When they sell calls, that puts pressure on option prices and makes option prices go down. What happens when stocks go down? Well, people get scared because net, people, I mean, not net, but just direct relationship, people, every share that exists, somebody owns those shares. So people get nervous when the stocks go down. And people buy puts to protect those shares of stock. When people buy options, the price of options goes up. These changes that I'm describing, stock goes down because they sell calls, stock goes up because they buy puts. No, wait. Volatility goes down and option prices go down because they sell calls. Volatility goes up, option prices go up because they buy puts. That's the change in implied volatility. So like I said, I would say that holds true for about 80% of the stocks. And the stocks that it does hold true for, it holds true about 80% of the time. So first, let's talk about what that implies. If the delta is 50 and the stock goes up by $1, and let's just say the same day, there's no time decay, and let's pretend there's no gamma, which is not true, but let's pretend it. Stock goes up by $1, I'm going to make $100 on delta. But implied volatility is going to go down on 80% of the stocks 80% of the time. So that means I'm going to make less than $100. So that's what I call, in my book Trading Option Greeks, which I know some of you have read. In my book Trading Option Greeks, I call that the effective delta. It's the actual delta taking into account the effect of implied volatility changes. So for all intents and purposes, I mean, the delta is the delta, but the stock is going to move as if it has a smaller delta. Because when the stock goes down, volatility goes up. Stock goes down, making it worth less by the delta, less, be worth $100 less. But implied volatility is going to go up, making those calls worth a little bit more. So you're not going to lose $100. You're going to lose less than that. I'm not talking about gamma. I'm talking about implied volatility. So the effective delta makes the delta seem like it's smaller than it actually is. Makes the option position make or lose money as if the delta was smaller than it actually is. So there's one thing. What's the other thing? Well, Passarelli said 80% of the time it happens to 80% of the stocks. Eighty percent of the time it works 80% of the time. So first of all, what about the other 80% on those 80%? That there's not really a good answer for. It's just sort of, there's some randomness. Sometimes when the stocks go up, people don't buy or sell calls. Sometimes when the stocks go down, people don't buy puts. You can't predict it. You can't control it. It's just how it is. Now, what about the other 20% of stocks? Now I've got some answers there. There are some stocks, mostly the really I don't know what the word, sexy stocks, right? The fancy ones that everybody's talking about, that are the high flyers that everybody likes to trade and talk about and pay any price for, doesn't matter. Or short squeeze stocks. Hey, I think there's so many people short this. I think there's going to be a short squeeze. I'm going to buy calls. I don't care what price I'm buying them. These two scenarios, the really in demand stocks or the short squeeze stocks, people buy calls on them. They don't sell. I mean, some people will sell covered calls, but a lot of people will buy calls because if the stock has a chance of going up drastically, well, first of all, you probably don't want to be short covered calls and get caught up in that and leave so much money on the table. The other thing is you stand to lose just a little buying calls, and you can make a massive amount if the stock blasts higher. So this idea means that when stocks go up, people start buying more calls in some of these meme stocks, short squeeze stocks, stocks that are in the limelight. They start buying calls as it's going up. That makes implied volatility go up on these stocks when the stock goes up. And when the stock goes down, people just figure it's boring. They sell out those calls. I'm just estimating that there's about 20% of the stocks adhere to that. And you should know those. And you can look at those. You can just pull up on Firstrade an option chain and look at the the Greeks and implied volatility screen, and look at the implied volatility for each option. You can just see as the strikes go up, the implied volatility usually goes down, but on some stocks it goes up, and vice versa. If the implied volatility is higher for higher strikes, that means if the stock goes higher, usually that means the implied volatility will go higher. All right, does that all make sense, friends? That all makes sense? Give me a big old yes. Any final questions before we call it a day and I go to lunch? Negative? All right, everybody. I'm going to see you next week. Next week, we're talking about, next week's a great one. We're talking about how to create success with devil spread, not devil spreads. Devil spreads? What am I talking about? Debit spreads. David, thank you. I appreciate that comment. I try. Kaylin, you're welcome, my friend. Manish, what's a good site to get delta on stocks? Well, to get delta on options, technically. Firstrade is a good site for that. Just go to the option chain and you can toggle over to the delta screen. Go look for it. You'll find it. Thanks, Larry. All right, Manish. David, you're welcome. Yeah. Hey, so Camille, right. We've got people who are brand new to options. We've got people who have been trading them for 10 years. So I try to do my best to sprinkle a little in for everybody. So here's what you do, Camille. Go to the YouTube, and Kaylin's asking about this too. Will this video be available to rewatch? Yes, Firstrade puts them on their YouTube channel. Just search on YouTube for Firstrade. Remember, there's just one T, not like Market Taker. And go through a lot of, especially mine. I don't know. I can't speak for the other folks, but like I try and really give you every single thing there is about option trading so that if you are new to it, some of the stuff will sound complicated in the beginning for sure, but the more you hear it and the more you hear it explained different ways and in different contexts, it starts to click. So do that. As they say, the more you learn, the more you earn. So do that and you'll be in good shape, my friend. Mike says, Delta is an estimate. Any studies confirm accuracy? You're welcome. No, because it's not mathematically. Delta is, well, hold on a second now. Delta is an estimate of the likelihood of an option expiring in the money. So it's an estimate because it's not actually mathematically exactly correct. You don't need a study. It is a fact that it's not actually mathematically correct. It's just a loose rule of thumb. Okay. So there's your study. That is a fact. As far as delta being correct for how much the option moves, that is 100% correct every single time. Okay. Now, if the delta is 50 and the stock goes up by $1, it's not going to go up by exactly 50 cents. Why? Is delta wrong? No. Delta changes. There's gamma that affects it. Time decay affects it. Implied volatility affects it. But the delta, how much the option changes as stock goes up or down, that's not an estimate. That is a fact. There's just other things that affect it. So that is also a fact that doesn't require studies either. All right, Mike, you're welcome, my friend. Have a great rest of your day. Everybody trade smart, and I'm going to see you next week. Bye.